especially
There
when
you go.
when you hit that late August up to Labor Day time frame, because that's a time frame that everyone's like, oh man, I can't believe summer's almost over. I got to go spend time with my family. I got to go out to the Hamptons. I got to go on vacation. Let's do something before school starts up again. This year, I don't think, yeah, I would lean that this is probably the first time ever where it may not exist. And not
I
to
would
mention
agree.
there's just so much headline risk out there, so much rhetoric, and it goes beyond political. It has to do with the COVID virus as well. I think people can't walk away from this market. The VIX is, where's the VIX at these days? 23?
Look at the 200 days at 27. I can't remember seeing that in a
Yeah.
long time.
So I think this is one of the few and hopefully rare times that we don't see the dog days of summer going on here. Markets,
Yeah, I would agree with you.
and you have a high unemployment rate too, and supposedly, you have a lot of people trading and going. And I mean, I did take a little bit of a break, and I did escape for like 3 days, just to get away and clear my mind and everything. But I wouldn't say it was super crowded anywhere I went, and we, plus you have to social distance, and you just kind of went into the middle of nowhere, and there really wasn't much to do except to like maybe jump in a pool or a lake, and then that was it. So
Yeah.
Has
All right.
has anybody looked at the trading volume on a year-over-year basis? Out of
On
curiosity.
a year-over-year basis, I have not.
I have not, but I would imagine
Yeah.
it's got to be the highest in a long time.
Yeah, that's what I'm assuming. So I'll see if I can find that. I was just doing a quick search while we were talking about that because it's definitely something we've been talking about a lot. Probably something we'll address in the trader strategy meeting on Thursday.
Mhm.
But Brett, obviously, a lot of focus on gold today.
Just real quick to answer your other question, NYSE 200-day T-vol is almost double over the last year.
Yeah. So there you have it. No summer doldrums for the most part, right?
Yeah, right. I think, yeah, exactly.
And
All right, so go ahead.
and we're 12 days into August too, so it's a pretty decent sample size that we got there. So all right, Brett. So obviously a lot of eyeballs on gold, GLD getting hit hard today. The gold futures, of course, too. Also on the way down to 1930 here at the moment on the continuous. That's down just over 100 points, which is an odd move for gold. We usually don't see something that aggressive. A lot of things at play here. The dollar rallying, of course. The 10-year bouncing up to 0.65. So I'm curious as to your thoughts on why gold's moving so aggressively today. And then I got a couple other questions just to kind of fire off at you, too. And Scott, obviously, feel free to jump in on any thoughts you have on this, too.
Yep.
Yeah, so sure. There's tipping points, particularly in markets that have become kind of, widely traded momentum markets, and gold certainly moved into that kind of mode or tone over the last couple of months. It's sort of like, the flower blooming on a stem that's been growing for the last year or so. And I think that when you get into that kind of different mode where you've got a lot of new participants in a market that's doing exciting things, you're going to get to various tipping points that get more extreme as they get more extreme. There's kind of a recursivity to how much momentum you can get in either direction. And there's a lot of new participants in gold. I mean, you can look at GLD moved up the list on the Robinhood accounts, week over week, new popular added list. By last week, I think on week over week, it was up well into the top 50, maybe in the top 30.
I would just say, too, anecdotally speaking, Brett, on our own feedback, the amount of people that were asking about gold and when they could get in and stuff over the last 3 to 4 weeks has been really busy.
Yeah. So there's a lot of new participants. There's a lot of loose money. There's a lot of inexperienced money in terms of trading gold in particular. So that's contributing to things. But the main catalyst, and I talked about this a little bit ago and again this morning and yesterday morning, is this shift that we're seeing in real interest rates. So that's kind of like, I think that's the sun. In any situation in markets, there's a solar system of different markets, and different things become the sun over different periods. A lot of times it's the dollar. Right now, I would say it's interest rates, generally speaking, particularly developed world interest rates at the long end of the curve. So, and particularly relative to inflation. So real interest rates at the long end of the curve, particularly in the U.S., I think that's kind of everything's revolving around that dynamic. Now, there's a question about what's causing that dynamic to change, but what's changing is real interest rates are moving higher. The number one thing that you can find throughout history that's correlated with gold in terms of major changes in tone is changes in real interest rates. When they're negative, when you get negative real interest rates, right? So, the rate of inflation is above the 10-year or whatever, you tend to get really powerful gold bull markets. And we've been living in that world for the last few months. And so when we suddenly see this inflection point or seeming inflection point took hold on Friday after the jobs data, I'm not necessarily sure it's totally related to the jobs data, but that's the timing of it. We started to see a pop higher in real interest rates. That's kind of started this domino tipping series that we've seen, and it's changing a lot of things. And one of the other things I pointed out is one of the relationships I've looked at a lot over the last few months is the Dow NASDAQ kind of ratio, and the NASDAQ's been crushing the Dow. I posted a chart this morning showing, like, over the last few months, if you just look at it as a ratio, and over the last few days, the Dow is crushing the NASDAQ. So that change has happened at the same time as this meltdown in precious metals, and that shows you that it's really about interest rates. Because the NASDAQ tends to outperform in a situation where you have kind of sustained disinflationary pressures. You get growth not because of macroeconomic growth, but because of innovation in an environment like that. So the money starts to slosh into companies that have a premium based on innovation rather than on the economic cycle. Like, you're not going to see Caterpillar outperform, you're going to see Google outperform in a situation where interest rates are pinned to the floor. So that tends to go together. And what we've seen over the last few months is this powerful rally in gold and the NASDAQ together. And that's this situation. And the way that I talk about it today and this morning and this afternoon is the idea that it's almost like the game's been rigged. The playing board's been fixed by the Fed to act this way, to be held this way. And if reality doesn't change, it will stay this way. So you've got a lot of leverage that moves in. When people feel the game is rigged, they feel like there's no risk, and it just pile up the leverage in these types of trades. And suddenly, starting on Friday, we've seen a little bit of an indication that it may not be as rigged as it looks like it is. And I think there's two ways to understand that. One is that there's a more optimistic outlook coming. So real rates are increasing and interest rates are increasing generally because, hey, this whole situation, this whole crisis state we've been in for the last few months is maybe starting to abate, and we're starting to see the light at the end of the tunnel a little sooner. We may not even need the new big congressional fiscal stimulus package. We're starting to turn the corner, and that's why you'd see real rates really take off, because the Fed's not going to step in and double down its efforts to pin it, because things are starting to shift under the surface. So that's one explanation. The other explanation is because of all the trillions we've had to put out there, the deficits are so bad. I mean, they're coming to market this week, I think, with just an absurd kind of issuance of bonds. So you could see it as the bond market is starting to fall and yields are starting to rise because there's so much supply of bonds coming. So that would be the more pessimistic interpretation. So either way, though, one of those two forces is causing this, but either way, something is causing the landscape around interest rates to shift. And again, that's been like the sun at the center of the solar system of markets. That's causing the financials to take off because you get this yield curve, net interest margins shift. We're seeing energies take off. We're seeing the Dow pound the NASDAQ right now. We're seeing the metals decline. We're seeing the dollar flip. We're seeing LQD take a hit to the downside. So everything is kind of moving because the sun has shifted.
Right. Yeah.
Does that make sense?
That makes total sense. And it was interesting today too. I don't know if you saw Ball Corp earlier today, Brett. It was it's a junk bond rated aluminum company, and they were able to borrow at a record low 2.85% for a 10-year. For a 10-year bond. So maybe that is an inflection point. One of the things I was talking with Scott about prior to this was the PPI number that came in pretty hot
Yeah,
today
saw
too.
it, right.
And it follows China's inflation on Sunday night that was
Mhm.
a little bit hotter than expected. But we of course have the CPI tomorrow. We got import and export prices on Thursday, and then Friday we get some the Q2 unit labor cost prelim number. So perhaps there's maybe some anticipation, and we talked a lot about this on last Thursday in our Sentiment and Flow show, that maybe inflation's starting to peak up. So maybe the selling that we're seeing in equities is a little bit of a concern, that the idea that the Fed might have to raise inflation sooner than expected. Perhaps that's playing in to a certain degree here. You got any thoughts on that?
Well, so I would say they've already done the work. We talked about it last week, that they've done the work of saying, hey, we got this new thing we're going to do, average inflation targeting, which means we get more leeway because we can see it coming too. We're going to start to see inflation numbers heat up a little bit, and we don't want people to think that means we're going to raise rates suddenly. So I think they've already gotten out in front of that one, but that means that there's maybe virtually no chance that we're going to see like yield curve control or some more creative moves, which the market may have been partially pricing in, which means you can get a steepener trade naturally in the market. And that's going to open up the upside for financials. We're seeing, like you guys were, I know, posting on JP Morgan earlier today, really taking off.
Yeah.
A number of bank stocks are, the XLF, FAS. That's been one of the prime things driving this flip in the Dow Nasdaq ratio, and that's ultimately based on the idea that we could see a steepening of the yield curve.
Right, that and the industrials. And it should be interesting because we do have a couple of Fed speakers tomorrow, Brett. And I don't know if you saw, I guess they are holding Jackson Hole. We were wondering
Right.
if they
Yep.
would on August 27th to 28th. So the idea is that we already had the Wall Street Journal trial balloon on that inflation targeting. The idea is that speakers are going to start getting it on in front of people, and you're going to see it kind of really posted in Jackson Hole, and then in the September 16th meeting, that is when it's going to be unveiled. At least that's what the theory
Average
is.
inflation targeting.
The average inflation targeting. So
Right.
that'll be a big theme coming up. So the two of you, I'd be curious, Brett. Obviously, you've got a lot of technicals on your side here. You also have a lot of fundamentals behind gold. Scott, I would be curious as to the two of you debating the chart on gold, and would you be buyers on this dip? That seems to be the big question. So I'll let the two of you answer that one.
I'll let Scott go first.
Of course you do. It's easier to always go second, right? So it depends on your time frame. So I would just say, like, short term, you have a nice. I'm looking at the GLD, by the way. I'm assuming most people are focusing on the equity side instead of the future side. But the GLD has a nice bullish gap that came into play around July 27th that basically got closed today with the dip below 180. So it came down to about 179-ish, 178. I would say that alleviated a lot of the overbought conditions that have been in play here to various degrees. I haven't put a Fibonacci ratio on it yet, but I'm sure there's something coming into play on this pullback off of the July low of the last leg higher. And I'm sure I can come up with something else, but I would say for a short-term trade, I'd keep it on the radar tomorrow. I wouldn't get long any right now. I'd like to see how it kind of behaves. I'm willing to see if it breaks down tomorrow and then reverses, and then maybe get a little bit of a bounce out of it. But bigger picture, if you're not in it yet, I'm not. I would say, and you're not a day trader, I would say you just kind of chill out for a little bit, see if it gets a little bit further down towards the 50-day moving average, maybe the midpoint of July's area, somewhere around 173, and then you start taking your chances there. So that's my overall look. But overall, big picture uptrend, multi-month. I think it's a yearly. We've had yearly breakout in gold here. It has made a really strong run, but there does come a point where these things, the exuberance in these things gets a little out of control, like we talked about the last few days, and I'd just rather see the proof of a reversal in context of a bigger picture uptrend before I get involved. So.
Yeah, so I would agree with almost every single thing Scott just said.
Except for
So
the levels, maybe, right?
well, so I don't focus on the levels as much. And you said one thing that really kind of gets right to the heart of what I would do, which is it's not so much exactly what the level is, it's how it gets there. And I would like to see a transformation in the mode of the market. This has been a reasonably orderly and steady kind of downward trend today, and I'd like to see it get some panic into it,
Yeah.
especially if it happens like one of the times when we see this in China. I mean, I've traded gold for 2 decades and a lot. In fact, it may be the market over the course of that entire period of time that I've traded more than any other market. And one of the keys for me is the 24-hour cycle, particularly over the last 10 years or so. You tend to get kind of capitulatory extremes in moves just somewhere around 15 minutes before to 15 minutes after Shanghai opens in the evening, either that or Europe. When you get the openings of major new markets, and oftentimes in the middle of the night, you tend to get the kind of like you'll get maybe a level holds here, holds a little bit this afternoon, but then people who look to buy the dip in the U.S. get kind of puked out in the futures markets when you get into some of the international markets. They take it down, they react to it, and you get some really you can get some really extraordinary, 5-10 minute moves that really kind of give you a whole new framework to push back against, to where you dig your heels in. So I'd like to see the tone and the mode of the way that it's moving shift. And that's more important to me probably than the exact level that it's at. I guess maybe I'd like to see at this point to see it puke the 1900 level, maybe around off of the China Open.
Right. Hey, Brett, do you use any sort of like sentiment indicator for gold? Like, is it commitment of traders or is it options?
Commitment of traders mostly, yeah.
There's no like open robo ratio for gold or anything?
Not that I found that I would trust.
Okay.
I mean, now there is GLD on Robinhood, which is an important indicator for me. But
yeah, that's a good point. I was glad you brought that up. Like, that's always a nice thing to know as well.
Yeah, exactly. I mean, with the other side of it, with the commitment of traders, I found mostly that it's really useful for when to be no longer bearish. If you've been very bearish and short in gold, when you start to see the small speculator net position shift to short. It's very, very rarely happens that you see speculator interest in CFTC shift to net short gold, and it really usually marks tremendous long-term bottoms.
Right. Yeah, and then just to add into that too, I probably wouldn't trade gold just in the bubble itself. I'd probably be looking very close to the way the bonds are behaving, as well as the U.S.
Absolutely.
dollar, as well as the S&P and the equity market. I mean, because the gold is one of those things where I feel like it doesn't move on its own. It's a byproduct of everything else moving around it. So you have to watch everything. So
I would agree with that.
Cool.
All right. Well, that's a great discussion there. So hopefully that helped people provide a little bit of direction on what to look for in gold, and we'll certainly be looking for the follow-ups from you guys as we head in towards the end of the weekend. We'll be able to circle back around in 2 days when we have our trader strategy meeting as well.
Yeah. Hey, I have a quick question for both of you. So a lot of these COVID plays popped today, I guess, in the response to Russia's potential vaccine that they claim to have, and they're going to spit out, right?
Right.
Well, I see a lot of those names like RCL, the cruise lines, and my favorite Dave & Buster's giving up some gains there, and as well as some airline stocks that have made some pretty decent run-ups here with some gap-up reversals. Do you think this is kind of all a good opportunity to stay short some of these names that have been popping, say 20, 30% in the last 3 days? Or would you kind of just avoid that trade altogether?
I think you could stay short them for a rollback over here myself. I think that we're going to see that 11th hour talks in the Senate going on, and there's going to be concerns on whether or not the airlines and cruise lines could find us more funding. So I think that we'll see a rollback over. People realize that really all Russia announced was a phase 3 trial that they're running in real time, which there's already a ton of them running at this moment. But definitely seems like COVID concerns are easing. So I think the next few days you could get a rollover, but I do think that they're a little bit more viable here at these lows.
Okay.
I would agree with that broadly. I think a lot of these plays are. are in a difficult situation, even post-vaccine in reality.
Yeah.
And the idea that you build up to this and gap up on something like that probably sets it that way. If I have any reservations at all, it's just because of something that I posted earlier today, which has started to get me feeling like there's the possibility. And again, as I posted earlier, I'm going to say it again, but I'm also going to put all the disclaimers on it because it's such a sensitive topic. I don't have any. I'm not a virologist. I'm not an epidemiologist. And what I say about the virus is not in any way meant to be from a voice of medical research authority at all. I'm just going from my own personal network, and I'm reporting my own personal experiences. But I've had, I think, 6 people now who are in some way connected to people in medical research confirm to me as I've reached out to people after hearing it from a couple people that there's starting to be among individuals and anecdotally a sense that the people are getting less sick from this. And it's possible that will start to become established more formally, and that could have an impact on some of these plays.
Well, they're learning more. I mean, like I'm seeing studies that say probably one of the worst things they could possibly have done was put people on ventilators.
Well, it's not just learning more. It's that every outbreak has a natural evolutionary process that takes hold, because viruses spread better when they don't put people in bed 24/7 or kill people. So every outbreak gradually mutates tending toward being less viral, less intense in terms of how sick it makes you, just because the virus is more capable of spreading that way. It wants you walking around in the world and breathing it out. It doesn't care whether it hurts you. It wants to spread. Like it's programmed to select towards strains that can spread better. So every outbreak gradually becomes less virulent over time. And as I understand it, for this to be happening now seems a little ahead of schedule, but that's just what I'm hearing. So we'll see. It may become a more formal idea in publicly available press. If it does, probably these plays will be a little tougher to short.
Yeah. There's a great skit by George Carlin. Remember him?
Yeah.
Oh, yeah.
Comedian. He did a great skit on germs and why he prefers to be, like, dirty. Just to build up his immune system and his antibodies, you know, as opposed to being clean. I mean, it's a fantastic skit.
I practiced that at home all my life.
Especially when you have kids. Yeah, right?
Yeah, they help.
Yeah, so.
I'm just more annoyed because I've got the Gator, and now they're saying that not only does it not protect you, but it makes things worse right now. So I got to figure.
I'm sorry, Gav. What's the Gator?
So it's like the neck scarf, basically, that you could.
Oh yeah, okay, the cool ones, the ones that cool people wear.
Oh, gotcha.
I'm one of those cool people, but I also like.
But you looting? That's a looter thing.
Well, no, I like walking the dog, and I don't like wearing the mask, so I'll just pull up the Gator every time. And now I'm just reading something about some study that says not only does it stop at anything, but it also makes it worse.
Collects the material probably as you're walking around, yeah.
I guess.
And I just saw a study too that said something about dental disorders and hygiene problems from the essential workers that have to wear these like for 10 to 12 hours a day during their shifts, especially the big N100 masks that are like rubberized and everything else like that. So they're having issues and stuff. So
I figure I'll just wait 10 years and there'll be another study that says something completely different. That's usually how I find things go.
Yeah. I want to know when Walt Disney's going to come unfrozen. That guy is supposed to be frozen for years. I wonder if he's just like, you know what? Don't ever unfreeze me.
I thought it was some bad Frozen movie joke that you were making.
I don't know where I was going with it. I'm just kind of randomly coming up with thoughts in my head.
Is he really frozen? Kind of like Ted Williams, I guess?
I think that's the theory. I don't know.
Yeah.
You know me, Gav. I throw out random stuff. So.
All right. Real quick, too, just some late after market news here. We got Overstock announcing a 1.7 million common share offering. We continue to see these common share offerings being pushed out the door as people are just rushing to raise money. Probably a good move by Overstock here.
Good call.
All right,
guys. Yep.
Well, hey, Brett, thanks for joining us. I'm sure people appreciated that talk around gold. And if anybody's got any questions, as I said, feel free to write in, and we'd be happy to answer them.
Yeah, Brett, don't be a stranger in the afternoons. You're always welcome.
Yeah, no, this is fun.
Yeah.
Let's do it more often.
We do exciting stuff in the afternoons, Brett.
I can learn more about Walt Disney, and it's great.
Exactly.
It's all good.
All right, you guys have a good one. We'll talk to you tomorrow.
All right,
Okay, take care.
Bye.
Thanks.